All right, so here we are on October 25th, 2017, and our topic for tonight has to do with the do's and don'ts of things that LLC managers can and can't do, because many of our clients are LLC managers in order to facilitate private investment of their retirement account funds, and this is a key topic for everybody to be sure they understand. So we typically get questions along the lines of, what kind of service can I provide, and can I reimburse myself for expenses? So if you're the manager and you incur an expense, can the LLC reimburse you for your expense if your self-directed retirement account is an investor or owns the whole thing? So we'll be talking about the dimensions of those two issues tonight. The first is a little bit longer than the second, but I think you'll understand why as we get along. So first, I just want to make sure that everybody understands what I mean by a SDRA or SDRA. And what I mean by that is it's an acronym for self-directed retirement account. And so we're talking about traditional IRAs, Roth IRAs, solo K plans with participants' accounts, a 401k plan of an employer that allows self-directed accounts for participants. Those are very rare. And an inherited IRA or Roth IRA. In other words, the Roth IRA that's been inherited from somebody who was the original account owner. So we're going to make a couple of assumptions. One is that your SDRA has invested in an LLC and that you are the manager or one of the managers of the LLC. And the next assumption is a universal assumption. The two options there actually cover everything that isn't the other option. So, but I'm doing this to kind of make it a point. So your SDRA either controls the LLC by itself or together with you and or other owners who are disqualified persons. In other words, your retirement account, for example, your IRA, and you own co-invest in an LLC, or your retirement account and you and family members invest in the LLC. That would be a controlled LLC if there's nobody else who has any control over it. And then, of course, if your your retirement account does not control the LLC by itself, or together with you and or other owners who are disqualified persons, that is also a situation where you have to be careful as a manager for certain types of things that you could do, even if your IRA doesn't control the LLC, and even if you could control the LLC by yourself without the IRA. So, just to review, there are three required elements of a prohibited transaction. One is that there have to be one or more disqualified persons involved, and it has to be one of 6 types of transaction that are directly or indirectly engaged in with the self-directed retirement account. And the transaction has to involve plan assets or assets that belong to the self-directed retirement account. So let's talk about one or more disqualified persons. So the baseline for disqualified persons in all cases is anybody who's a fiduciary. If you're a fiduciary, then you're of a plan, you're a disqualified person with respect to the plan. That doesn't mean that you're a bad person or that anything can't be done. It just means that you fall within that definition of disqualified persons. Family members of fiduciaries, meaning people who are your descendants or your ascendants, your parents and grandparents, but not your siblings. And entities in general that are 50% or more owned by fiduciaries and their family members. So those are generally the kinds of disqualified persons that we run into in this context. So who's a fiduciary? Well, a fiduciary is any person who exercises discretionary authority or control over management of a plan, or who exercises discretionary authority or control over the management or disposition of plan assets, or who exercises discretionary authority or control over administration of the plan, or renders investment advice to the plan. So that means that a SDRA owner is always a fiduciary of a self-directed retirement account because they exercise discretionary authority or control or the management or disposition of plan assets. You're always in control of the assets in your self-directed retirement account. The custodian has to follow your instructions in terms of what you invest in. And so you're in control and you're the fiduciary. So there are 6 types of transaction, directly or indirectly, that have to be engaged in with the SDRA. And here they are. The first 3 are the typical kinds of transactions that you might expect: sales and leases between a disqualified person and a plan, loans between a disqualified person and a plan, furnishing of goods, services, or facilities between a disqualified person and a plan. All of those things are prohibited transactions. Then, of course, we get into a little bit more complex issues in the areas that I would refer to as conflicts of interest. So there is the personal benefit rule, the self-dealing rule, and the kickback rule. So let me just explain what the statutory language for those last 3 is. First of all, the first one, and these are subsections of the section of the code where the prohibited transactions are listed. So the transfer to or use by or for the benefit of a disqualified person of the income or assets of a plan is a prohibited transaction. We refer to that as the personal benefit rule. In other words, you're not supposed to get a personal benefit from your retirement account other than distributions. The second one is an act by a disqualified person who is a fiduciary. Notice you have to be a fiduciary. It isn't just being a disqualified person. You have to be a fiduciary of the plan, whereby he, or we should say she, deals with income or assets of a plan in his or her own interest or for his or her own account. So in other words, that's a situation where a fiduciary is self-dealing. That's the self-dealing rule. You're using assets as a fiduciary for your own purposes, for your own interests, or for your own account. And then the last one is the receipt of any consideration for the fiduciaries for his own personal account by any disqualified person who is a fiduciary. Again, you have to be a fiduciary to violate this rule, from any party dealing with the plan in connection with the transaction involving the income or assets of the plan. So that's what I usually refer to as the kickback rule. In other words, you're entering into a transaction with plan assets with the expectation that the person that you're entering into the transaction with is going to give you something. The example that's given in the regulations for that is if you invest in an insurance company with the expectation that they're going to issue a life insurance policy on you. So those are the statutory language and the translations. So let's talk about some examples. So for example, let's say that a SDRA loans money to a venture in which the SDRA owner has an interest. In other words, if you're a fiduciary or you're a disqualified person and you own an interest in a venture, and a retirement account as to which you're a disqualified person makes a loan to that venture, that could violate the personal benefit rule. The second one, the typical one, is personal loan guarantees. In other words, using your retirement account to guarantee or to secure a loan of your own. In that case, what you're doing is you're self-dealing. You're using the plan assets for your own personal use. And then another example that has been actually litigated, where a person gets a free checking account from a bank in exchange for LLC deposits or IRA deposits at the bank. So if you make a deposit at the bank with your retirement account, or with your retirement account that owns an LLC, and you make a deposit with the LLC, and for that you get a personal checking account for free, that would be getting a kickback. It's kind of minute, but the typical example would be, I'm going to invest in your venture, but I want you to give me a commission. So those are kind of kickback rules. So those are the 6 types of transactions. So if your SDRA holds an interest in an LLC and you are the manager and you do anything at all Are you committing a direct or indirect prohibited transaction with your SDRA, even if you're not compensated? Well, and remember, that's, if we look at the transactions, you can't furnish goods or services or facilities to your retirement plan. And the answer to that is, well, that depends. That's the answer that all lawyers give, but that's the answer that I have to give in this case. Under the code, there is a list of like 22 to 25 exceptions to the, or exemptions to the prohibited transaction rules. And 2 of them are key in this area. The second exemption that's listed says that reasonable contracts or arrangements with disqualified persons for office space or legal, accounting, or other services necessary to establish or administer the plan for reasonable compensation, that's okay. So in other words, if you're providing office space to your retirement account, because that's where you keep track of all the ins and outs for your LLC, that would be covered by that exception. Note, however, I've underlined services. So services, if you're providing services to your plan as a fiduciary, and the services are necessary to establish or administer the plan, then you're performing what we refer to as settlor functions. In other words, they're the functions that someone who sets up a plan would do to make the plan run. If the word settlor comes from trust law. If you establish a trust yourself, then you're referred to often as the settlor of the trust. And the other exemption is the receipt by a disqualified person of any reasonable compensation for the reimbursement of expenses properly and actually incurred in the performance of his or her duties to the plan. So in other words, expense reimbursements are allowed through the exceptions. So there's 2 exceptions to the prohibited transaction rules that you can rely on providing services, and they even say you can do it for reasonable compensation. But there are exceptions to the exceptions. So here's the exception to the exceptions, and it's in a particular subsection of section 4975, which is where all the PT prohibited transaction rules are. And it says that the exceptions that I've just listed, and there are 22 of them, the exceptions don't apply in certain types of transactions with people called owner-employees. Now note, I put in a parenthetical there that says except numbers 9 and 12. Number 9 is an exception to the prohibited transaction rules that allows your plan to make distributions to you as a participant or beneficiary. Obviously, that has to be an exception to the transfer of assets between a disqualified person and the plan. You have to be able to get your distribution of benefits. And number 12 is actually on the other side of that transaction, distributing. In other words, when the person who has custody of those assets distributes assets to a disqualified person, that again has to be an exception to those rules, and they are. But so the exceptions to the exceptions say that all the exceptions, with the exception of numbers 9 and 12, don't apply to any transaction which a plan directly or indirectly lends any part of the corpus or income to, pays any compensation for personal services rendered to the plan, or acquires for the plan any property from or sells any property to any owner-employee. All right? And then, of course, family members or corporations in which the owner-employee owns 50% or more of the total value of all classes of stock. So these are what we call the owner-employee exceptions to the exceptions. So that's a very key and important section, because it makes us take a second look at the exceptions to see whether this provision actually prevents us from relying on the exceptions. So what is an owner-employee? Well, the code actually defines it. The word owner-employee refers to sole proprietors, and within that definition, I would include the owners of single-member LLCs. So if you have a single-member LLC and you're considered, if you own 100% of it it's considered a pass-through entity, or IRS considers it as kind of invisible. You have to report all the income on your own personal tax return. You don't file a tax return for the LLC, just you report all the income on your personal tax return. So you're treated in that case just like a sole proprietor. And then partners owning more than 10% of the capital or profits interest in a partnership. So you could have 4 or 5 partners each owning 10% or more of the capital or profits of an interest in a partnership. And each one of those could be owner employees. And note that it says capital or profits. So you're going to have a capital account, that's the what you actually own, your prorated share of the assets in the LLC, and you can also divide the profits between the partners differently from the way you divide the capital. So it doesn't matter whether it's either capital or profits, as long as you have 10% or more of either of those, you can end up being an owner employee of a partnership. Then there's something called shareholder employees. This refers only to people who own 5% or more of the stock of a subchapter S corporation. All right, notice it says subchapter S corporation, not a C corporation, which is the general form of corporation. Subchapter S corporations are pass-through entities. There is no income tax paid at the corporate level, just like partnerships and sole proprietors. So those are called shareholder employees. And a particular type of shareholder employee that's actually done by definition in the code is a participant or beneficiary of an individual retirement plan. In other words, of an IRA. So the owner of the IRA is considered also to be an owner employee. So those are the 4 types of owner employees. And those are the people who can have transactions to which the exceptions to the exceptions apply. So how about some examples? If you're the owner of an LLC that owns a solo K plan, then you can be an owner employee, considered an owner employee, and you're not supposed to have transactions that are listed in that exception with the plan. Partners owning more than 10% of the capital or profits of interest in a partnership with a 401k plan, owners of 5% or more of an S corporation with a qualified plan, that could be a profit sharing plan, a 401k plan, etc., and any IRA owner. Okay, so IRA owners are always subject to the exceptions to the exceptions. So no services are allowed, right? Well, not exactly. Let's take a look at the exception to the exceptions again. What it says is you can't have a transaction directly or indirectly where the plan pays any compensation for personal services. It doesn't say any transaction where the owner employee provides personal services. It says that they can't be paid for personal services. So that's the key. That means that although you can't be paid, it doesn't say that you can't provide services under the exception that I showed you before. So here's the exception. Remember, you can have reasonable contracts or arrangements between the plan and disqualified persons for office-based or legal, accounting, or other services necessary to establish or administer the plan. And note that I've stricken out the words for reasonable compensation because you can't be compensated. If you're doing a set lower function, that seems to be okay, but you're violating the code if you are compensating yourself for those services. So, what is a service that's necessary to establish or administer the plan? Okay, so that's the key. If you're the manager of an LLC and you want to know whether you can provide a certain service, even if you're not being paid for it, you want to know whether what the service is necessary to establish or administer the plan. So, fortunately, IRS has given us some regulations that specifically say how we're supposed to approach that. And it's really in the first sentence here. The service is appropriate and helpful to the plan obtaining the service and carrying out the purposes of the plan for which the plan is established or maintained. In other words, a service is necessary or to establish or administer the plan if it's appropriate and helpful to the plan, obtaining the service, and carrying out the purposes for which the plan is established or maintained. Well, okay, what does that mean? The second sentence, by the way, is where we're allowed to furnish goods in connection with those types of services. That limited type of services that we're referring to as settler functions, we can also furnish goods to the plan where it's necessary for the establishment or operation of the plan in the course of and incidental to the furnishing of such services. So if you're doing settler function services and you're not being paid for them, and they're appropriate and helpful to the plan to obtain the service and carrying out the purposes for which the plan is established or maintained, then you're fitting within that exception. So what services of a manager are necessary to establish or administer the plan? So I would give you two basic tests. One is, consider whether a plan trustee, a fiduciary, or a custodian would conduct these types of activities. Can the plan operate? Can the plan actually do what it's supposed to do, keep track of its assets, keep track of what its value is and all that kind of stuff without that work? Well, that's what a trustee, fiduciary, or custodian does, keeps track of all of that. And are these activities necessary to operate the business as opposed to establish or administer the plan? Are they necessary to operate the business, or are they necessary to administer the plan or carry out its purposes? In other words, if you're talking about a service that's necessary for the business, but it's not necessary to administer the plan or carry out its purposes, that would not be a settler function. So let's go over some examples. These are examples of what I would refer to as settler functions. These are things that your retirement account, if it's investing in an LLC, and think of this in terms of it being 100% owner of the LLC, to make it simple, receiving revenues from the operation of the business and depositing the checks. That has to be done. You can't just leave the checks undeposited. Writing checks for expenses. You can't actually have the money come in and out of the business and keep track of what the business value is and how much cash is represented by the ownership without doing that. Accounting for the receipts and expenses of the venture, making distributions of profits to the account custodian. So if you've got a single member LLC and or a multi-member LLC and you have completed the activities of the LLC or the business, and you're thinking about investing in something else, but you know you're not going to need the money for now, you want to put it back with the custodian, invest it in publicly traded securities, you make a distribution to your custodian back into the retirement account at the custodian level, and that's okay. That's a distribution from the LLC. Of course, reporting the value of the LLC units to the custodian is something that we have to do every year as the manager of the LLC. And everybody who is a single member LLC, and often people who are managers of multi-member LLCs with, for example, Pensco, you actually sign a letter that says you're going to provide that information to Pensco. So reporting the value is really important. And another one is analyzing the projected cash flows and value of real property for possible purchase. That is akin to deciding whether if you're investing in publicly traded securities. That's the same kind of thing you're doing when you're looking at the brochure or the circular you get that describes what the mutual fund or security is that you're investing in, the offering circular or whatever it might be. So you have to analyze that if you're going to invest, and you're a fiduciary, that's what fiduciaries do. So analyzing the projected cash flows and value of real estate for possible purchase, if you're the manager, that would be a fiduciary function. That's a settler function. Deciding whether to purchase a property. Again, that's the same thing as deciding whether to purchase a publicly traded security in the account. Analyzing whether a proposed borrow is a good credit risk. So again, you're analyzing whether you're going to make an investment in a particular loan. So that would be a settler function. And even in deciding on the terms of the loan. Notice I'm not saying necessarily negotiating the terms of the loan. You might hire an attorney to do that, but unless you're an attorney. But if you're deciding on the terms of a loan or deciding on the terms of some kind of transaction, that's what you do when you're making an investment. Well, what about examples where you're doing things that are necessary for the operation of the business? So let's say your IRA or your retirement account has invested in a bar. Well, if you went into the bar every night and attended the bar, well, that's an activity that's necessary to operate the business, but it's certainly not something that's necessary for the administration of the retirement plan that owns it. So if you're doing flips, if you bought a piece of property and you're having it renovated in order to resell it quickly, and you own the LLC with your retirement account, going into the building and doing the drywalling yourself would not be a settler function. That's something that's necessary to actually do the business of the business. Collecting rent arrearages might also be something that you wouldn't do as a settlor. That's something you'd hire somebody else to do. You certainly wouldn't go out and walk up to the tenant's door and try to collect their rent. That's not something that's necessary for keeping track of things. It's necessary to keep the business going. Then let's say that you established that your IRA invested in a used car dealership. And you became the used car sales manager, which is what happened in the Ellis case a couple of years ago. That, again, that is not a settler function. That's actually operating inside the business. So I think you can see the distinction between activities that are necessary to administer or establish the plan or keep it operating correctly, and those that are necessary to be involved in the business. So let's do a little bit of a summary for SDRA owner managers. You exercise discretionary authority or control, so you're basically making decisions and delegating work over the management or disposition of plan assets. In other words, over the LLC's business activities. All right, so you're exercising your discretionary authority or control over the business activities, but you're not actually performing the activities themselves. They're necessary to establish or administer the plan. They're settler functions, and you have to do it without compensation. So that is typically what single-member LLC managers do, or multiple-member LLC managers do that have retirement accounts invested in them. Those are the kinds of activities that they do. So what about reimbursements? Well, we can be reimbursed for direct expenses properly and actually incurred in the performance of services. Okay, so what is directly incurred? Well, an expense is not a direct expense to the extent that it would have been sustained had the service not been provided, or if it represents an allocable portion of the overhead costs. So the typical example of this would be if you have a business and you're providing office space and you're allocating a percentage of the lighting in the office that you've decided to provide to the plan, that would not be a direct expense. That's something that's just overhead expense that would have been incurred whether the plan was occupying the room or not. But if you, for example, you travel on the business of the enterprise for a specific transaction relating to an IRA investment, maybe that would be a direct expense. So let's take a look at a couple of examples. So if you were to travel on, let's say you had a single member LLC and you were to travel to some place, negotiate a deal for the LLC, and you had to stay overnight. All right, so if you went to, can you go to Motel 6 or the Ritz? Well, remember, it has to be reasonable. It has to be incurred in the performance of the services, and it has to be provided directly as a result. So, what about those services? If you go to the Ritz, you're certainly, and you're getting having that paid for when you could actually attend, if you could go to a much less expensive Motel 6, are you getting a personal benefit from the excess expense? Should you go first class on an airplane or economy? Should you get a mid-sized car or an economy car when you're driving, if you're renting a car? What about the gas and the mileage? What's the rate at which you should charge the LLC for gas and mileage. All of these things are very difficult. So it's in order to avoid having a prohibited transaction when you pay yourself, reimburse yourself an expense, you have to make sure that you're being fairly conservative in what expenses you're actually incurring, and that you're not actually doing something that's primarily for you and not only for the enterprise that's owned by your retirement account. So then there's other things that are out-of-pocket expenses that basically you have to incur. They're expenses that are dictated by the market. So, you know, you can't negotiate with FedEx about what their charges are going to be. So if you had to mail something out on behalf of your LLC through FedEx and then you got reimbursed for the FedEx costs, it was directly in connection with the services that you're rendering let's say you were FedExing the checks to your custodian for the distribution checks. Well, that would be an expense that you could be reimbursed for, because that expense is actually determined by a third party, by the market. Same thing with postage. So those are out-of-pocket expenses that are fairly clear that you could get reimbursed for. The problem can come when there are travel expenses that there's some kind of wiggle room about whether it's a reasonable cost or not, and there's no third party involved in the actual determining of what the expense amount is. That's when we could get into trouble. So I always suggest to clients that unless it's really, really clear that you had to incur the expense in connection with the settler functions that you are doing as a manager, I would stay away from reimbursing myself. So again, let's get back to the requirements of a prohibited transaction. Again, we have these three. So we have the last one, and that is plan assets. So what are plan assets? If we're not dealing with plan assets, you know, we don't have a prohibited transaction. So a plan asset is any asset owned by a SDRA or any other type of plan. So the question then is, are your LLC's assets plan assets? And if they're not plan assets, paying you for services or expenses can't be a prohibited transaction, right? So does a SDRA that owns an interest in an LLC own just the units of interest or the assets of the LLC too? So if you're an IRA and you invest in an LLC, you instruct your custodian to put the money into the LLC. The custodian is issued units of interest, and that's what it holds in your account. The question is, are the assets that are inside the LLC also considered plan assets? So here's the rule, and this is a Department of Labor rule. This is not an IRS rule. This is the Department of Labor. So where a plan holds an equity interest in an entity that is neither a publicly offered security nor a security issued by an investment company registered under the Investment Company Act of 1940, and that would be a mutual fund, for example. The plan's assets include both the equity interest and an undivided interest in each of the underlying assets of the entity. Again, let me repeat that. If it's not a publicly offered security, and it's not a mutual fund, and the entity is owned, the IRA or the retirement account is owning an interest in the entity, then the assets of the entity, the general rule is that the assets inside the entity are plan assets, as well as just security or the units of interest that are issued to the IRA. All right? So that means that an LLC manager is a fiduciary of his SDRA investors, even if he's not otherwise a disqualified person. Huh? Well, okay, if you're a manager of an LLC and you're making fiduciary decisions on behalf of the limited liability company as a manager, and the assets of the LLC are plan assets because of this rule, then you are a fiduciary of the plans that own an interest, even if none of them is yours. All right? That's something important. And this is actually why the Department of Labor issued the plan asset rule, because managers of LLCs want not to be fiduciaries of their component owners, their investing owners. So how do we get around that? Well, so what the Department of Labor did was they made an exception to this general rule. And that's the plan asset rule exception. So that's true. The IRA owns the underlying assets inside the entity unless it's established that the entity is an operating company or the equity participation in the entity by benefit plan investors is not, quote, significant. So what do we mean by benefit plan investors? So that's any of our retirement account investors that we talked about earlier. So if equity participation by retirement account investors is significant, then the assets inside the entity are plan assets. All right? Unless it's an operating company. So let's talk about I'm going to talk about the significant test first. So significant benefit plan participation means that equity participation in the entity is less than 25%. So if retirement accounts and other benefit plan investors own less than 25% of the entity, then it's not going to be a plan. Assets inside the LLC are not going to be plan assets. However, when benefit plan investors own 25% or more, the significant test has been passed. So unless something else intervenes, the assets inside the entity are plan assets. So if a SDRA owns 25% or more, you want the entity to be an operating company, and that's how you get around the plan asset rule. So what's an operating company? Well, here's the definition. It's an entity that is primarily engaged directly or through a majority-owned subsidiary or subsidiaries in the production or sale of a product or service other than the investment of capital. All right. So in other words, if the entity is primarily engaged in the production or sale of a product or service other than the investment of capital, it can be an operating company. So if you own a hardware store, if your retirement account invests in a hardware store, that sounds like an entity that would be producing or selling products and services. So that's an operating company. If you own a gas station, that's a company that's producing or selling products or services. So, and that's not the investment of capital. But the investment of capital would be, let's say that you're a bank that's primarily involved in the investment of capital, or you're a broker-dealer that's involved in the investment of capital. That could not be an operating company under this definition. Now, there are two specific types of operating companies. One is a real estate operating company, and honestly, since 80 to 90% of investments in retirement accounts are invested in real estate, most entities, when they qualify, are going to be real estate operating companies. Those are operating companies that either operate or invest in real estate for the purpose of long-term investment, or operating the investment, or selling the real estate, developing and selling the real estate. Those are real estate operating companies. And then there's something called a venture capital operating company. All right, so you can be a venture capital company, and if your primary activity is investing capital, then typically you're not going to be an operating company unless you satisfy the definition of a venture capital operating company under the Labor Department's rules. And the key to that, and there's several different paragraphs that define things that you have to do in order to qualify, but the key one is that if you're an entity that is investing money in subsidiaries, you're a venture capital operating company if you have substantial participation or influence over the conduct or management of the operating company. So you have to, if you decide that you want to invest in a chain, for example, of hardware stores, and you get management rights over how that chain of operating stores is being operated, then you can be operating a venture capital operating company. All right, so those are the definitions of operating companies. Again, remember that investment of capital is not going to be an operating company. So if you're a company that is making loans to third parties, that would not be providing a sale of a product or service. So lending companies are not going to be operating companies. So if you're investing in a lending company, unless benefit plan investors are less than 25%, the loans themselves can end up being assets of retirement accounts, of the retirement account investors. So, and so the manager of that entity, even if they're not a disqualified person otherwise, ends up being a fiduciary of their investors. So that's the kind of thing we have to be careful about. So, but in most cases with self-directed retirement accounts, investing in real estate and that kind of thing, that's not something you're generally going to be concerned about. So let's do a summary of this exception. So if your LLC is an operating company, its assets are not plan assets. And so you would conclude then that does that mean that if you have a transaction with your LLC, it can't be a prohibited transaction because it doesn't involve plan assets? All right, so here's the question. You have an IRA that's invested in an LLC. The LLC is an operating company, or your retirement account owns less than 25% of it. So the assets are not going to be plan assets, the assets of the LLC. Does that mean that if you enter into a transaction with that company, that since they're not plan assets, it can't be a prohibited transaction? Well, unfortunately, the answer to that is no, because the Department of Labor has also they clarified these rules with another regulation that I refer to often as the pass-through PT rule. And what it says that in general, if a transaction between you and your SDRA would be a prohibited transaction, the same transaction with the LLC it owns or controls, alone or together with disqualified persons, will also be a prohibited transaction. So even in the case where your retirement account owned less than 25%, if you, together with your retirement account, own 50% or more, or can control the activities of the LLC, your transactions personally with that LLC could be a prohibited transaction anyway, even though the LLC doesn't have any plan assets. So the only time the pass-through PT rule doesn't apply is when the SDRA investor, the retirement account investor, can't require the transaction by itself or together with other disqualified persons with respect to it. All right, so if you and your retirement account are minority owners in an LLC and you can't control whether the LLC enters into a transaction that would otherwise be a prohibited transaction with your retirement account, then you've passed this rule, you've passed this test. Aha, but there is one other exception that we can talk about, and that is where the transaction occurs after the investment by the SDRA in the LLC, but by prior arrangement. So in other words, if you make your investment and you own 30% of the LLC and there are other independent investors that own assets in the LLC, and you obviously can't control whether the LLC actually hires you, okay? But if the plan is that you're going to make this investment of 30% of your own assets and IRA assets or just IRA assets, and the expectation is that you're going to be hired by the entity once it gets running, that's a violation of the prior arrangement rule. The prior arrangement rule, for example, would not be violated if you had the entity, you made the investment of 30% or 40% less than a controlling interest, And a couple of years down the road, the entity is doing really well, and your child comes home from college and needs a summer job, so applies to the business, and somebody else interviews them and gives them a job. That's not a prior arrangement. There's no control. You can't require them to hire your son or daughter, and there was no prior arrangement with it. So here's some examples. The IRA and disqualified persons own 51% or more of the LLC voting rights. They can require the transaction. So number two, if the LLC was formed and the investment was made in order to purchase property from the IRA owner, that's a prior arrangement situation, all right? Even if the IRA owner and their retirement account own less than 50%. The LLC was formed and investment was made in order for the LLC to provide employment to the IRA owner's son or daughter. Remember, the example I just gave you was 2 or 3 years down the road. This was not anticipated when the LLC was started, so that wasn't done by prior arrangement. In this case, if you make the investment expecting that your son or daughter is going to be actually employed for the summer up front before you actually make the investment, that's a violation of the prior arrangement rule. You're basically using the assets of the retirement account for your own benefit, for the benefit of a disqualified person. So that's the pass-through PT rule. It's somewhat complex, and it takes a very careful analysis in many instances to really understand what's going on. And oftentimes I'm asking people for a whole bunch of facts to find out whether they can do what they're asking me about. So here's a summary. This is a summary of all the kinds of things that we've been talking about. So first of all, the SDRA owner can be a manager of an LLC in which it invests, all right? So the IRA owner manager can provide only settler or fiduciary services to the LLC and only without compensation, all right? If you have a question about that, please call us first. Use that first call privilege before you make a mistake. Make sure that you check with us. The IRA owner manager can be reimbursed for certain types of expenses, but I would suggest that you call me first. Remember, the first call gives you the ability to call me and ask me any question about a transaction that's going on or you're contemplating with your LLC. I'm perfectly happy to talk about whether the expense seems like it could be reimbursed or not. The LLC assets are plan assets unless the LLC is an operating company. All right. If you want to know whether your LLC is an operating company or whether the LLC has plan assets, call us. And then transactions between the LLC and disqualified persons are probably PTs, even if the LLC is an operating company, because of that pass-through rule that the Department of Labor has, which basically says that if it's a prohibited transaction, if it were done directly with your retirement account, it's a prohibited transaction if it's done with an entity in which your retirement account invests, unless certain things are true. You and your retirement account can't control whether the entity enters into that transaction or not. So that's the summary. I'm going to unmute everybody and ask whether anybody has any questions. So, does anybody have any questions?
No questions from my side.
Okay. Anybody else? All right. Well, thank you very, very much. It's been a pleasure. Have a lovely evening, and I know the game is on fairly shortly, so enjoy the game, and we'll be speaking with you soon.
Thanks. Have a good night.
Good night, everybody.